Now think, what is an inversion fair value gap? ICT, how do you know when you're doing your live trades and you're annotating them, you're calling an inversion fair value gap before it even forms, before it even trades there? Right. That's authorship. You would expect that, right? So let's go into it here. From this candlestick's low to that candlestick's high. Are you having fun? Are you learning anything today? Because I tell you, man, if I was my 20-year-old self and some guy was on the internet showing me this stuff over live price action, I don't know, I would be giddy. So now think, okay? If I'm bullish, if I'm expecting price to go up to here, and we're only right here, and we're trading up into it, everyone else that thinks that they see this as a liquidity void, or stocks being hunted and a liquidity void, and we're going lower, they would see that as a short entry. Not me. Not me. And I can say that because you watch me do it example after example of live executions. When I called it on Twitter a lot, I would say, okay, take that fair value gap, extended to the right. What am I telling you? I'm telling you that this right here, this sell side imbalance, buy side inefficiency, where the candlestick's low of that candle right there, which is that. Let me move it over just a little bit so you can see again. Let me zoom in actually because I want to make sure you understand exactly what's going on here. I want your money's worth, okay? So this candlestick's low and this candlestick's high right here. That portion on this candle, that's what I'm highlighting. What is that? The algorithm will go right back to this time frame, right back to this range in price action, being this. That candlestick's low, and this candlestick's high. And we're gonna darken up that rectangle's mid level. Okay, and I want that to be bolder like that. Okay, so that's what I'm highlighting there. Okay, and let's go back out to, oops, a little too far. Already, some of you already see what's going on, don't you? I can't believe it. I can't believe this stuff really works. So because I'm bullish, I'm going to look at old sell side imbalance, buy side inefficiencies, or down close fair value gaps as a rock climber. Okay, I'm going up. I'm trying to climb the surface of this rock surface to get to this liquidity. And maybe if I'm strong enough and hold on long enough, I might be able to get to the zenith of that high back there, like I talked about real time before I did it. If that's the case, I know that this imbalance exists. Because if this is there on the sell side delivery, part of a what? Part of what? A market that is potentially going higher, then I'm going to treat this as a foothold or a hand grabbing point as a rock climber. And I'm going to wait for it to trade up above it. My hand's going to use it to pull me up higher in my trade. And then I'm going to wait for it to, I'm going to get above it, and then I'm going to trade long when it moves into this area. Why? Why should I do that? Because it's going to act as support. Because why? If it's going to go higher, it's inefficient over here because it went down on this candlestick. Inefficient delivery and repricing for that range between this candle's low and this candle's high would be seen with candlesticks that go down in that same specific range that's highlighted in orange. Once we got above it, what did it do? It traded down to the low of it. And then what happened? Oh, look at that. Some mysterious movement to the higher side. And it ran into the buy side. Did it stop there? No, it ran right to the level I told you it would reach for. Okay? Is that hindsight, folks? Is that hindsight? Because this is the logic that I use every single time I'm making executions. Inversion fair value gaps are old inefficiencies that are opposed to the trade direction you're in. When you understand this, you will understand how also my market maker models are not Wyckoff, because this right here is your unicorn. Second stage reaccumulation, smooth consolidation, smart money reversal, low risk buy, accumulation, reaccumulation, second stage, whoop, 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 Where's the biggest move? Right there. Hello. So, oh, I love this. Anyway, we're going to go down into the 1 minute chart. Okay. A macro only exists 10 minutes before the top of the hour. That means, in this case, what time is this? What time is that right there? It's 7:51. Okay. That's 9 minutes before the hour of 8 o'clock in the morning. So if we take a rectangle here and you go to 7:50 to 8:10, that is the macro. See that? What did the market do? We're bullish. Where's the buy side? Here, because it stopped right where it did over here on the 15-minute time frame too. That's this candlestick right here. That candlestick's high on the 15-minute time frame is that individual 1 minute candle right there. See that? So what does it do? It drops down at 7:51. What is it doing? It's dropping down to take the liquidity out here on that low. To do what? To start spooling. Where? To clear the liquidity above here. When we see this, I shouldn't have that color because that's not what that should look like. We'll do this. And no midpoint because it's not measuring anything. So you can be trading futures or Forex with these macros. Okay, so it's not limited to any one particular asset class. Inside and center. Right? And what you want to do is when you're tape reading, you want to spend the majority of your time focusing on what price is doing 10 minutes before the top of the hour to 10 minutes after. Okay. What happens is the price engine that is the algorithm many times will spool. Okay. During these times, and it will run to where the stops are, or it will run to where the inefficiencies are. And what do I mean by that? Inefficiencies are gaps, whether they're up close gaps or down close gaps. One singular candle moving in one direction, that's an inefficiency. And that's what we've been talking about and showing here. So this is the algorithmic price run. This is just the run-of-the-mill scalp. Which one would you rather be a part of? If you're trying to buy on a day like this and it's bullish and you're aiming for the levels I was outlining here when we first started our live stream, which one would you rather be a participant in? Some random price only entry versus a very specific algorithmic advantage where price will absolutely start spooling and reaching for the liquidity based on time first. Clearly, it's not even a competition here. Seriously, look at this. Boom, all the way up to the high I told you it would run when we first started streaming. Okay, so there's clearly something totally different here that puts you in a different league. You're in a totally different league of trader. Your perception about price action is light years ahead of everyone else when you think like this, because you're aligned rather with price. You're in alignment with what the algorithm is likely to do. You're going to read it sometimes wrong. Sometimes I do. Sometimes I get all bent out of shape and feel like I want to show off, and I do something that is a little too beyond the scope of what the structure at the time is I'm trading in. Sometimes I'll do that. But when it does this here, then we can go back into, okay, what are we looking for if we miss this move? Well, what's this low? Let me take the executions off real quick. And we'll go right into tape reading the opening range. We have a low, high, lower low. That makes this up close candle a breaker. I don't draw all this stuff on my chart, but you should, because it'll help you frame everything. And if you're back testing, this is what you want to annotate on your chart. You want to have all these types of things on your chart, because it helps you identify it and remember visually what these things look like. And the market trades down here. And also, what is it doing here as it trades down into that bullish breaker there? This is not support and resistance, because support and resistance would have been, okay, well, it went above here, so it should stop there and go higher. That's how I lost money in the 90s, because I thought it was so easy that support and resistance is going to be the be all end all, and it wasn't. I lost a lot of money trying to do that stuff. And it's the entire range of the up close candle. The highest up close candle is your breaker. In this case, it's not even trading down to the low, but what is it doing in addition to that? You see this? That right there is a nesting of two PD arrays. So this is an old buy sign imbalance, sell sign inefficiency, fair value gap that was used right here, and it went up. But did it rally above that high here since this movement here? No, it didn't. It's consolidating. So it drops back down to it here, and you're still inside that breaker. So you have to afford, if you're trading long, your stop can't be so trailed up to get stopped out prematurely. So that's all factors of how I would measure where I would move my stop. So if I was going long down in here, if I went in and bought this immediate rebalance, which is the open trading down immediately, going back to this candle's high, that is extremely strong. And I'm not making that up for the purpose of being here live and it had already happened. Go back to where I was talking and teaching immediate rebalances. They are the bee's knees for entries. If you can get in, or if you're supporting your trade with a stop loss below a immediate rebalance and your targets or liquidity hasn't been traded to, the market is absolutely not going to your stop loss. And you heard exactly what I just said. That's not me exaggerating. Don't take my word for it. Look at my examples when I'm executing. Go back and see if there's ever a immediate rebalance, my stop loss is just above that or below that in relative terms to the direction of the trade. This is logic that I keep using all the time that repeats over and over and over again.